Welcome to Words of Stardon. This is CH. I will be covering the Lion-OCBC Securities APAC Financials Dividend Plus ETF that has the SGX code YLD in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from some viewers' comments in my previous videos. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. The Lion-OCBC Securities APAC Financial Dividend Plus ETF, as the name implies, appears to be a collaborated solution between Lion Global Investors and OCBC Securities. I, however, could not find any information of the specific role or involvement by OCBC Securities in the ETF webpage and documents, so I am not sure what exactly is OCBC Securities' contribution to the product. Lion Global Investors is a Singapore-based asset management business that was rebranded in 2008 from Lion Capital Management, and is the result of the merger of the asset management businesses from OCBC and Great Eastern in 2005. OCBC is the second largest banking group in Singapore, while Great Eastern is the largest and oldest life insurance company in Singapore and Malaysia. Great Eastern and Lion Global Investors are both subsidiaries of OCBC. Lion Global Investors currently has about 79 billion Sing dollars of AUM, with core competencies in long-only mutual funds and ETFs across fixed income, equities, and multi-asset solutions. Given the nature of the setup, there is a notable tilt in the product offerings towards servicing OCBC retail banking business and the private banking business under the Bank of Singapore or BOS entity. Lion Global Investors also has several collaborations with other local and overseas financial firms to launch market or thematic focused products. OCBC Securities is the brokerage and trading business subsidiary of OCBC and was established since 1986. Its product coverage includes direct and derivative equities, bonds, futures, FX, and precious metals, as well as REITs and ETFs. The Lion-OCBC Securities APAC Financial Dividend Plus ETF is set up as a Singapore standalone unit trust and is listed on the Singapore Exchange as an exchange-traded fund or ETF. The stock code for the primary currency Sing dollars is YLD, as mentioned earlier. While the Lion-OCBC Securities APAC Financial Dividend Plus ETF is a passive ETF tracking an index, and therefore fund managers play a less important role, the ETF prospectus does state Ng Kian Peng and Herbert Wong as the portfolio managers for the product. Interestingly, both of them are from the Multi-Asset Strategies team, and that makes me wonder why does Lion Global park this ETF under this team instead of its equities team. Perhaps it is because of Kian Peng's experience in ETFs, but it is nevertheless still a bit strange in terms of product categorization. The Lion-OCBC Securities APAC Financial Dividend Plus ETF passively tracks the iEdge APAC Financials Dividend Plus Index, which is where the ETF got its name from. This index is created and launched in 2024 by SGX under its SGX Indices business arm, and has data backdated since 2012. The index is base currency in Sing dollars. The index essentially is designed to track the 30 largest and most tradable companies in the financial sector in Asia Pacific with stable dividend yields. Given market constraints, the index specifically considers only Australia, Hong Kong, Japan, Singapore, Korea, Indonesia, Malaysia, and Thailand in terms of countries by listing. Specific index constraints such as maximum weight on individual stocks and country of listing, as well as specific stock selection criteria such as liquidity, free float market capitalization, and dividend thresholds are clearly stated in the methodology document of the index. The index is reviewed and rebalanced on semi-annual basis. The index fact sheet provides more details on the portfolio and index performance. Important to note is particularly the 12-month dividend yield of the index that is currently at 4.27%, which we will use to compare against the ETF distribution payout later. The performance numbers also look very strong in the table provided. Investors should, however, note that the numbers have been all put up by the exceptionally good returns in the recent 2 years, and therefore should not be considered as the normal long-term expected returns. The index provides country breakdown in 3 different ways. Exposure by country of listing is used in the index constraints. However, that's not what investors would normally look at. Exposure by country of domicile is the most common method used by funds and ETFs. And here, we can see the index is mainly comprised of 5 countries that are Singapore, Japan, Australia, China, and South Korea. There is also an exposure by geographic revenue that is less common, but this is actually quite useful for investors to understand the country risks involved in terms of business stability of the underlying companies. While the index intends to cover the broader financial sector, given the nature of the market, it is inevitably having maturity exposure in banks, with only about 11% in insurance companies and 5% in investment services. The index labels all the banks as international banks, though I would consider some of the names more like regional banks instead. The Lion-OCBC Securities APAC Financial Dividend Plus ETF is one of the newer investment solutions from Lion Global, having incepted and listed only in May 2024, that is about 1.5 years ago. The ETF is a passive investment product, with the objective to replicate as close as possible the performance of the iEdge APAC Financials Dividend Plus Index that we went through earlier. The ETF primarily uses a direct replication approach, that is to invest in all the underlying index securities with the same weightage if practicable. In event if the ETF is not able to adopt a direct replication approach due to market constraints, it will use a representative sampling approach, that is to invest in a subset of the index securities with the aim to achieve a similar performance. Given the index only has 30 constituents and they are listed in the main stock exchanges in the region with decent liquidity, I think the ETF will be able to do a full direct replication in normal circumstances. A key feature of the fund strategy is to provide a stable quarterly distribution. We will discuss this later in the fund distribution section later. The ETF also markets itself as the world's first APAC Financials ETF. While this is true, investors should note that the iEdge APAC Financials Dividend Plus Index is a relatively new index that covers a small universe with currently only 30 stocks. It is also based currency in Sing dollars, which implies the index is designed primarily for Sing dollar investors. There is actually a much older MSCI All Country Asia Pacific Financials Index that covers a bigger universe of 14 countries and over 200 stocks, and also base currency in US dollars, as with most MSCI indices to cater for global investors. There are, however, currently no ETFs available that tracks the MSCI index. Given this is a straightforward passive ETF, there is not much additional information on the investment strategy in the prospectus. There are just some elaboration on the direct replication versus representative sampling approach available to clarify when will the ETF change from one to the other. As this ETF is a relatively new solution from Lion Global, and there is intention to actively market it, the ETF actually comes with quite a number of different materials for investors. Besides the usual monthly fact sheet, the ETF also has quarterly newsletter, a sales brochure, and also a detailed client pitch book that is basically a sales presentation deck. The sales brochure is probably created for the launch of the ETF. It does quite nicely state the objective of the product, the key selling points, and trading information, alongside with data on the portfolio and performance of the index tracked by the ETF. One thing I don't like in the brochure is that it showed the index portfolio using the less common country by listing instead of the usual country by domicile. The quarterly newsletter seems to be an extension to the sales brochure by retaining the objective and key selling points, but provide more timely and recent updates on the market and the financial sector in the region to highlight the relevance of the product. The actual ETF performance and portfolio information are also provided. I think if Lion Global were to add the trading information page here, the newsletter can completely replace the sales brochure. The newsletter looks a little outdated though, because I can only find Q1 2025 version in the website. Client pitch books are hard to come by, as it takes a lot of resources and effort to produce one, and therefore many fund providers are reluctant to produce them unless it is for an important product marketing push. I would suggest that all investors who are considering this product to take a browse at the pitch book document, as there is a lot more details and content not found anywhere else. Of particular importance is the elaboration of the market background and the opportunities available, as this explains the rationale of why Lion Global decided to market this product currently. There are some contents in the pitch book that are not so good though. For example, this is a slide showing the ETF offerings from Lion Global. And it appears that Lion Global is deliberately separating China-specific products versus broader Asia products. In this case, the ETF covered in this video is categorized under Asia ex-China. But as seen in the index construct earlier, we know that there is about 17% China plus Hong Kong exposure by company domicile and about 22% China plus Hong Kong exposure by company revenue. So the ETF isn't really ex-China. The fine print explains that this ex-China is based on country of listing, which has been bugging me through this video as I find this really misleading. I hope Lion Global can change it to country by domicile to make it more aligned to what most funds use. Another slide here tries to advocate that the financial sector is diversified and goes beyond just banks. Unfortunately, as seen in the index construct earlier as well, the current index is 84% banks, plus 11% insurance, plus only 5% investment services. So the index and the ETF are still very highly exposed to banks. One more thing to note is that while there are mention of India in parts of the pitch book, India is actually not included in the index and the ETF. Therefore, this ETF would not be suitable for investors who like the India financial sector. As earlier mentioned, the Lion-OCBC Securities APAC Financial Dividend Plus ETF was incepted and listed only in May 2024. That gives it about 1.5 years of track record. Fund size is quite small at just 88 million Sing dollars, which is a concern in terms of survivability of the product, as a major market correction or substantial redemptions can reduce the AUM to an unsustainable level, where then the ETF will have to terminate. The ETF therefore needs to grow quickly to at least 200 million to 300 million Sing dollars levels to be more stable. Lion Global unfortunately does it quite badly when it comes to provision of portfolio information for this ETF. There are no portfolio breakdown information available in the ETF webpage. The brochure, newsletter, and pitch book are all using index level information and are slightly outdated. The fact sheet has one donut chart showing industry breakdown that is completely useless because this ETF is focusing only in financial sector. So if an investor wants to find out more about the latest country breakdown and other portfolio statistics, the only source would be the index webpage in the SGX website that we went through earlier. This is not ideal because there will be small differences in the actual ETF portfolio versus the index that translates to tracking error of the product. An investor is investing into the ETF instead of the index. Therefore, it is important to disclose the actual ETF portfolio information, at least in the ETF webpage or the fact sheet. A consolation is that the ETF fact sheet does provide the full holdings list. That shows it shouldn't be difficult for Lion Global to create portfolio breakdown information. Ironically, the index only provides top 10 constituents in its fact sheet. So there is no way for an investor like me to cross-check the allocation differences in the entire portfolio. Looking at the top 10 positions, we can see very small differences where the ETF holdings are slightly smaller in allocation, and that should be due to the 0.83% cash in the portfolio. Given the lack of actual portfolio information, I'm putting up the index information here again for reference to discuss some portfolio-specific areas for consideration. As a Sing Dollar investor, this is a Sing Dollar-based currency investment product, but it only gives about 20% exposure in Singapore, that is essentially the 3 local banks. While the prospectus does mention the ETF can do currency hedging, there is no information available on how currency is handled in the index and ETF. While branded as an Asia-Pacific exposure, the index and ETF are mainly exposed in just 5 countries that are Singapore, Japan, Australia, China, and South Korea. Malaysia and Indonesia are included in the index, but are very small positions due to the free float market capitalization design of the index. India is notably missing in the coverage, despite having a decent growth in its financial sector in the past decade. Investors should therefore understand and accept that this is the exposure provided by the ETF before going for it. I also want to reiterate that this ETF is still pretty much a bank play with over 84% exposure, and investors should not expect much diversification beyond that, regardless of how the product is being marketed. This is not really a product problem, but is the nature of the current Asia financial sector that is dominated by banks. The Lion-OCBC Securities APAC Financial Dividend Plus ETF has only one share class, but provides trading in the base currency Sing dollars as well as in US dollars. There is therefore only one ISIN but 2 stock codes and Bloomberg tickers. The US dollars is simply a FX conversion on the Sing dollar price, and therefore it provides a currency unhedged performance in US dollar terms. Here are the performances of the ETF in both Sing dollar and US dollar trading terms. Again, the difference is the result of the FX movements of the Sing dollar to US dollar currency pair. The ETF charges a 0.5% management fee. Adding other expenses would give a total expense ratio or TER of around 0.6% per annum. Given this is a passive index tracking strategy, this means that the ETF should generally deliver a return that is around 0.6% lower than the index. This fee level is similar to other ETFs offered by Lion Global, although it is considered high if compared to the ETFs available in the global market that are offered by larger ETF providers. Lion Global doesn't provide much trading data for the ETF except for tracking error indicated in its webpage. The ETF currently has a tracking difference of minus 1.5% and tracking error of nearly 2%. This is significantly higher than the 0.6% TER, but I can't find any explanations why the tracking error is so high. Relying on Morningstar for more trading data, the ETF has been trading with rather minimum premium or discount gap since inception, and appears to be quite consistently trading at a slight premium since July 2025. I have omitted the volume chart here because the bars are too small to see most of the time, and there is no average volume data available. Trading liquidity is typically a concern for most ETFs listed in the SGX because the investor universe is small, though this is a long-term market problem and not the fault of the product. As briefly mentioned earlier, the Lion-OCBC Securities APAC Financial Dividend Plus ETF has a quarterly distribution frequency. The ETF interestingly sets a guaranteed distribution floor of 5% for the first 2 years, meaning it will pay out at least 5% distribution yield regardless of the market conditions and the overall performance of the ETF. There is a target of 5% payout yield from year 3 onwards, but this is no longer guaranteed, and therefore the ETF can decide to pay less or more than the 5% then. Fixing a 5% payout yield may provide income certainty to investors. However, this is a risky approach as it can lead to a deviation in investment experience compared to the benchmark index that doesn't have the same dividend policy. At the same time, the index is currently having a lower 4.27% dividend yield, meaning the ETF will have to convert some of the capital gains to top up to the distribution yield in order to fulfill the 5% payout yield objective. This guaranteed 5% yield for the first 2 years feels more like a marketing gimmick, and I would rather the ETF just stick to its core objective to passively track and replicate the index in terms of both performance and dividend yield. The ETF webpage contains only the distribution notices but not the distribution data. Lion Global consolidates the distribution data for all the funds in a downloadable Excel file. Based on the Excel file shown here, the ETF seems to be fixing a $0.0125 per unit dividend every quarter, and top up with a $0.03 per unit special dividend per year. This totals to $0.08 total dividend per year for its short track record so far. If we divide this $0.08 by the current NAV of the ETF, that gives us a 6.2% payout yield, which is pretty high compared to the dividend yield of the index. There are no details how the ETF will adjust this distribution policy after the first 2 years, though I suspect it will retain the $0.0125 per unit dividend every quarter and then use different amounts of special dividend to make adjustments to the yearly total distribution yield. Again, this will be different compared to the natural dividend yield of the index, so investors who are concerned with this should take note. Despite paying out over 6% of distribution yield, the NAV of the ETF looks to be growing decently since its inception. However, it has been a bullish market these 2 years, and therefore the ETF is experiencing substantial capital gains. As such, investors should take note not to treat the current performance track record as a long-term norm. The Lion-OCBC Securities APAC Financial Dividend Plus ETF has only price information in the webpage that is not too useful. The fact sheet does contain total performance information in the form of a cumulative returns chart and a table of various time periods as seen here. We can see the ETF has been tracking the index closely, as with what a passive index tracking solution would do. But the numbers in the table shows that the ETF has underperformed the index by around minus 1.5% per annum. That is the tracking error data we saw earlier. Again, the tracking error is too big, and Lion Global needs to find a way to reduce this. It is difficult to run comparisons for this ETF because there are currently no other existing products covering the same market and sector exposure. Plus, it is even harder to find products trading in Sing dollar terms. Here is a chart comparing the ETF against IDAP and ASDV ETFs that represent dividend-focused strategies in the broader Asia-Pacific or Pan-Asia geography. I have also used the Morningstar chart's currency setting to change the returns into Sing dollar terms for more consistent comparison. We can see here that YLD has been a much better performer, although having larger drawdowns in August 2024 and April 2025, because it is a single sector concentration and with only 30 stocks. Similarly, the ETF has outperformed active Asian equity funds with dividend-focused strategies. Again, this is because we are looking at a rather short time period where Asian financial sector has done particularly well, so this should not be assumed as a long-term norm. The performance chart in the index fact sheet shows us how abnormal the recent 2 years have been. As seen, the recent index performance looks very different from the longer-term norm of the past decade. Investors should therefore be more cautious when taking exposure in this part of the market and size your investments according to your risk tolerance. I do have to say it was timely for Lion Global to launch this ETF in mid-2024 to catch this bullish market period. Focusing on the financial sector gives us better comparisons. Here, we compare the ETF against XDWF, IUFS, and EUFN, representing global, US, and Europe financial sectors respectively. The global XDWF looks to be highly correlated to YLD, with nearly the same performance in this time period. We can also see that US financials had better returns in late 2024, but Europe financials caught up and did much better in 2025. This shows that big disparities can be seen even when comparing the developed markets of US versus Europe. And for long-term passive investors, it may be better to stick with a global exposure when it comes to sector play. Comparing YLD and XDWF is complicated. XDWF definitely gives a much more diversified exposure with its global portfolio and larger number of holdings. YLD, on the other hand, is Asia-focused and may appeal to investors who already have too much US and Europe exposures in their portfolios. Personally, I would make sure I have enough broad global exposures in my portfolio first before considering smaller regional exposures. With that, let's summarize our findings. Lion Global Investors is an asset management business under OCBC. While the overall AUM doesn't look too big, it does get ample support from the wider OCBC businesses. While OCBC Securities looks to be a co-partner in this product based on the product name, there is no mention of its involvement at all in the ETF webpage and documents. This is a straightforward solution that is a passive indexing ETF tracking the iEdge APAC Financials Dividend Plus Index using mainly a direct replication strategy. The index was created by SGX. Both the index and ETF are base currency in Sing dollars, and therefore it seems they are designed and created mainly for Sing dollar investors. While this is not a bad thing for Sing dollar investors, it does mean that the index and ETF will be rather limited in terms of attracting global investors. While this is the first investable ETF covering the Asia financial sector, and therefore should have some appeal to investors, it should be noted that the index construct is rather concentrated, focusing mainly in 5 countries and just 30 stocks. There is a much more diversified MSCI AC Asia Pacific Financials Index available, although it currently doesn't have any investable products that track it. One thing that bugs me is that the index and the ETF keeps using country by listing when providing portfolio breakdown information that may reflect the country risk of the product incorrectly. This is an uncommon practice as country by company domicile is typically used in the industry. Both the index and the ETF were launched only in 2024. While the index can provide backdated data, the ETF cannot do so and therefore only has about 1.5 years of track record currently. AUM is also still quite small at less than 100 million Sing dollars. And again, this is partly because there will be less interest from global investors in a Sing dollar-based currency product. Lion Global, however, has timed the launch of the ETF well, as the Asia financial sector has been bullish for the past 2 years. As a result, the ETF has exhibited a rather strong performance for its short track record, outperforming most Asia equity solutions as well as some of the global financial sector solutions. The ETF was launched with a minimum 5% distribution for the first 2 years, which looks more like a marketing gimmick to me. The index currently has less than 5% dividend yield, meaning the ETF will have to use some capital gains to top up to the distribution payout. This also means the ETF will have less capital growth compared to the index because more capital was paid out instead of retaining in the ETF to participate in the bullish market. This distorts the tracking of the index, which is what the ETF should be focusing on instead. In conclusion, as this is the first and currently only ETF in the market to access the Asia financial sector, it is a potentially interesting idea for Sing dollar investors looking to add such exposures into their portfolios. Investors do have to take note of the index constraints and the concentrated exposures, as well as the fact that this sector is currently experiencing a bullish period. Therefore, this ETF should be a small tactical play in accordance to individual risk tolerance. This concludes my absolutely biased comments on the Lion-OCBC Securities APAC Financial Dividend Plus ETF that has the SGX code YLD, and I hope it will help in your investment journey. May we all grow wiser and prosper.